Hi traders, in this new video we are going to cover some cardinal sins that traders make and which often cost them their whole trading account. The mistakes that we are going to cover in this video are quite often the reasons which cause the high number of traders to fail. As you will see in a few minutes, you can have profitable trading strategy, but if you are going to keep making those same mistakes over and over again, you might never make it in the trading industry. All serious traders that are trading capital for our proprietary company eliminated these mistakes early on, which allowed them to trade 5 to 6 figure FTMO account. If this is something that interests you and you would like to get funded for your trading, follow the first link in the description. Martingale. So for those of you who are unaware what Martingale is, commonly used money management strategy in casinos contains a simple model of doubling up your bet once you lose it until you break even. If we are going to use a simple roulette example, let's say that you bet $10 on black. If the ball ends up on the black, you win and bet $10 again on red. If the ball drops on black and you lose, you have to bet $20 on red again. And if you lose again, you have to bet $40, then $80, etc. until you win. After that, you start with your initial size. For those of you that are thinking that this is actually a pretty good strategy as chances of ball hitting red 5, 10, 15 times in a row are very small and you would like to try this, just don't. The record in American casino history is 32 consecutive times of red color on the roulette. The table on screen shows you what would happen with a $10,000 account when you would make 10 losses in a row. It would be completely wiped out. Are 10 losses in a row probable? Of course, that depends on your strategy. But if we are going to take a look at this equity simulator right here, even the strategy, which has an average risk-reward ratio of 2 and wins 50% of the time, has maximum of 18 consecutive losses on 1,000 iterations across 20 different equity curves. Now, does this make a bad strategy? Of course not. The strategy is highly profitable, but all can be wiped out very quickly once you start Martingale to make a shortcut from your losses. Since Martingale is quite a popular thing to do amongst traders, and we are sure that there will be someone with a different opinion, some time ago we published 2 articles on our blog with more details, and for more backtests of martingaling, you can find links in the description. No stop losses. What a lot of traders who don't use stop losses do is they justify it by the fact they don't want to get shaken out by 1 or 2 pips before the real move happens. Although this might be a valid argument, markets can move very rapidly, especially on a news event or some unexpected events that move the market. One of the fairly recent examples is the flash crash of January 2019. Flash crash that was seen in the value of US dollar, Japanese yen, and Australian dollar, US dollar, which dropped more than 4% in a few minutes. It was the US dollar's lowest level against the yen and AUD's lowest level against US dollar since March 2009. Does stop loss protect you 100% in those unexpected events? Unfortunately not, but although you can experience some sort of slippage, your account might still survive it compared to being on the other side of the crash without any stop loss, scaling into the loser. What is even worse that you can do if you are in a trade without a stop loss and it goes against you? Starting to add more. Looking at the March crash on DAX, out of 20 trading days, only 5 were actually positive ones. You often hear people talking about how they made a lot of money during market crashes, but you have to bear in mind that there are also people who try to catch falling knives and pay the high price for it. Another recent example, which actually happened to one of oil traders during the crash when oil prices went negative, he started a day with $77,000 account and ended up owing broker $9 million due to the fact that he kept buying into negative oil prices. His broker, the Interactive Brokers, ended up covering his $9 million loss with another $79 million their traders lost during the oil crash. All of them tried to do one thing: scale into the position. Even though they don't have to pay huge negative sums, they technically owe money to the broker. Their accounts are forever gone. Both scaling in and trading without a stop loss are extremely risky techniques, but can also be done properly. As a lot of traders sometimes have rather zones where they want to do business instead of single price levels, they might start to build up positions by a smaller fraction and buy more with lower prices. All of this has to be well thought of and calculated upfront, so you don't risk more than you can afford to lose, not making your own decisions. This might come out as a little bit of a surprise, but getting influenced by other people can be a big problem. The first one who mentioned this problem on our channel was our trader Holly, in the interview we did a few months ago. With the popularity of social media and plenty of people who either share their trading ideas or are constantly bragging about their wins, it is hard to not get influenced or feel as an underachiever compared to others. You might get pleasantly surprised how your trading can improve once you stop scrolling on Instagram, browsing the chat room, or hanging around on Facebook during your main trading session. Because even though the trading strategies or setups you find online can be valid, you should always use your own judgment, as you are the only one responsible for your trading results. Correlated pairs. Last thing on our list are correlated pairs. This is something not many traders realize when they are trading, but is one of the main reasons why they end up losing much more than they anticipated. As you can see on the chart, we have two trading pairs next to each other. On the left, there is Euro USD, and on the right is the pound dollar. As you can notice, we have a very basic technical setup on both, as the level of support was broken. And because of that, we might short the other side in expectation of a new resistance. As you see a great trading opportunity on two markets at the same time, you jump in and risk your full size on both of them without understanding that if one fails, there is a huge chance for the second one to fail as well. Why is that? Simply because both of these majors are crossed with dollars. They will be influenced by the move of the dollar index, and even though you are trading two different pairs, you are pretty much taking a bet on a strong dollar, which in this case didn't work out, and instead of your regular 1% risk, you lose 2. To deal with this, you can simply split your risk into multiple positions which bet on the same direction. Or you can just pick one with a better looking setup according to your strategy and go with that one only. Of course, there is a risk that the pair you have chosen will underperform, but you should never risk your full size on multiple correlated instruments. That can bring only trouble. This is it, traders. We hope you enjoyed the video. Let us know in the comment section down below if you ever came across one of these mistakes, and let us know if you overcame them and how. Also, don't forget to subscribe to our FTMO YouTube channel, follow FTMO on social media, and as always, trade safe.